Hello and welcome to the Tax Roundup for April, and happy Easter everybody. Now it's an interesting month when Parliament sits normally, and this month has been no different, with the introduction of the employee share scheme reforms into Parliament. We also take a look at a new draft ruling that'll be of interest to strata bodies, and then we look at two important cases. The first dealing with a capital or revenue account issued for property developers, and the second with the 183-day rule test for residency purposes. But first up, Michael Carruthers takes you through the employee share scheme reforms and the key points you need to know.
Now, for a lot of people, the most exciting development this month is the introduction of the bill in relation to the reform of the employee share scheme rules. Now, this has been coming for a little while. There was an announcement a little while back from the government suggesting that changes were coming. We had exposure draft legislation, but it looks like we're getting pretty close. The proposed start date is still 1 July 2015, so the new rules the plan is for the new rules to apply for shares issued or options issued from that date onwards. Now, just in terms of some of the changes that we're expecting to see and that are contained in the bill, first thing is the introduction of a brand new concession for eligible startup companies. So the plan here is that where you've got a company that has been in existence for less than 10 years, has aggregated turnover of under $50 million and is not a listed entity, shares and options issued to employees by those companies can potentially qualify for from extra concessions that we haven't seen previously. And I guess one of the main ones is that where only very small discounts are being provided to employees of those companies, those can be effectively tax-free and can be taxed in a much more concessional way. Some of the other things that we'll see in terms of a bit of the detail, at the moment the maximum period for deferring tax on shares and options is currently 7 years. That will be doubled. It would actually go out to 15 years. Now, there might be other things that happen in the meantime that will cause the taxing point to be triggered, but that maximum period will be extended. Another area that we'll see some expansion on is, at the moment, again, to qualify for some of the concessions, an employee is generally limited to holding 5% of the shares in the company. That will be doubled as well. So that maximum shareholding percentage will be doubled to 10% going forward as well. Now, there will be people at the moment who are missing out on some of the concessions because of those things, and so this will be a positive development for many companies in many industries. One of the other things that we're changing is that under the current rules, when someone has issued options and those options qualify for deferred taxation, generally the taxing point will be triggered when the vesting period ends. Under the proposed new rules, that vesting period won't necessarily be the trigger point. It'll be when the options are actually exercised by the employee, which could happen sometime later. So again, the ability for the employees to defer the taxing point a little bit longer until they've actually got the shares in their hands. So positive news all round. Certainly we'll see how things go through Parliament over the next month or two. But at this stage, looks like we might have some brand new employee share scheme rules in place for the start of the new financial year.
In rulings this month, Rae takes a look at a new draft ruling that's come out on the tax treatment of income received by strata bodies.
Okay, strata bodies. We've all heard of them. Some of us love them, some of us hate them, and unfortunately some of us had to deal with them. Now, there can be some quite complex tax issues to arise, and whether or not something should be recognised as income or not. So the Tax Office have actually provided guidance in this area in the past, in bits and pieces. Now they've withdrawn some older rulings and issued TR 2005-D1, which provides further guidance in these areas. So, a strata body is a company. It's basically owned by the members, the owners of the units within that strata complex. And under the mutuality principle, income from the members is not assessable income to the strata body. However, what is income from the members in this particular case? Classic example, the strata levies themselves. Those would obviously not be assessable income from the strata body because they are the funds received from the owners in relation to running the complex. However, what if there's something that's received from an owner, but it does not fall under mutuality? So the classic example would be the breach notice issued to the owner who's hanging their washing on the balcony, and they have to pay a penalty for that. That does not fall under the mutuality principle, and it is assessable income to the strata body. What about the common property that the strata has? If they charge a fee for that, how is that treated? Let's use an example of washing machines. Let's just say there's washing machines on the floors of the apartment complex, and the strata body charges a fee to the occupiers of those apartments who are going to be using the washing machines. Now, if the occupier is an owner, They're paying a fee for using services of the strata body, and they are one of the members. Therefore, that income from the owner is not assessable income to the strata body. But what if it's a tenant? If the tenant is paying a fee, they're not an owner. It's under mutuality, that's not covered. Therefore, it is assessable income. So those are just some examples of the issues that have been addressed and hopefully providing a lot more guidance for anybody who has to deal with strata bodies.
In cases this month, Mike looks at a property development case looking at that old issue of whether it's on revenue or capital account.
In terms of cases this month, the XXYZ case will be of interest to practitioners who have clients involved in property development. Now, the background of this case is interesting. The taxpayer bought 2 adjoining properties, and those properties each had a house on them. The original plan was to undertake some sort of development activity as part of a joint venture arrangement. Now, it turns out that the JV arrangement fell through, so the original plans never really eventuated. For a period of time, those houses were actually rented out. So residential rent was being derived by the taxpayer, and later down the track, and some years later down the track, the properties were sold just after a development application process had been completed. Now, the taxpayer in this case sought a private ruling from the ATO. They were arguing that the sale of the properties should be taxed on capital account on the basis that this was just merely a realisation of a capital asset. The Commissioner issued the private ruling and indicated that the Commissioner's view was this should actually be taxed on revenue account. The taxpayer objected and the matter went before the tribunal. Now, the tribunal ended up agreeing with the Commissioner. The tribunal said that when they look at what the taxpayer was planning to do, the intentions they had with respect to this property, they were actually carrying on a business, and a business loosely called a property development type business. The tribunal confirmed that the sale of those properties was made essentially in connection with that business, even though the sale and the process didn't necessarily look the way they might have expected it to at the start of the project. This was a sale that was made in the ordinary course of that property development business, and the profits were taxed therefore on revenue account, not on capital account. One of the big issues there is no CGT discount, not able to access capital losses, those sorts of things. Now, interestingly, the tribunal also went one step further and said, well, if we've got it wrong and this actually wasn't a business, would it still be taxed on revenue account? And the tribunal confirmed that yes, it would. The taxpayers, even if this wasn't a business, would still be classified as carrying on a profit-making undertaking, and this sale was made in consequence of that profit-making undertaking. Again, taxed on revenue account. So similar sort of outcome at the end of the day. So interesting one. We haven't had a case like this for a little while around property development and that age-old question of revenue versus capital account. Really important for practitioners to talk clients through this distinction early on in the piece, because it could significantly change the economics of the project they're looking at undertaking. Not only that, remember that the GST treatment can be influenced as well. So in this case, may not have made much of a difference because we had existing residential premises being sold, so presumably there wasn't a GST exposure. But if we're dealing with vacant land, if we're dealing with properties where the houses have been knocked down, then the GST treatment could be quite different to what clients might expect as well. So good case to see, because it provides a little bit more clarity, I guess, around when things might be taxed on revenue versus capital account. But again, making sure clients are aware of that distinction and where the dividing line might be, and what the implications of falling either side of that line are is quite important to help clients in their decision-making process.
And finally, Rae takes you through a case that deals predominantly with backpackers and whether you can rely on the 183-day residency test.
Residency. Who is a tax resident? We've had a lot of cases about this in the last 12 months, mostly from the perspective of taxpayers who don't want to be residents. Now we've got a couple of interesting cases about taxpayers who did want to be considered tax residents. There were 3 different cases heard at the same time by the AAT, and they all regarded roughly the same issue. A taxpayer who'd come to Australia on a working holiday maker visa, otherwise known as a backpacker visa, which is a temporary visa. Coming to Australia with the intention of being here for a holiday, supplementing their holiday with some work. And in all 3 cases, they had gone over 183 days of physical presence in Australia, but had not actually been here for a full tax year. Now, one of those common ideas out there is once you go over 183 days, you must be a resident. Unfortunately, that's a common misunderstanding. The amount of time spent in Australia is just one of several factors that the Commissioner would look at in trying to determine whether or not somebody is a tax resident or not. So with these cases, all three of the taxpayers had been in Australia, had originally come on a holiday, had been working for some of the time and had sort of longer term accommodation for a couple of months during the period of time they were working, but then travelling around Australia, staying in hostels and other backpacker type accommodation. All three had left Australia and returned to family homes overseas. They had all wanted to be considered tax residents, and that may possibly have had something to do with the fact that tax residents have a lower tax rate. That is not mentioned in the case. However, in all three cases, the AT held that the individuals who came from Canada, Denmark and Germany were all individuals who were not residents of Australia for tax purposes based on the facts and circumstances. So the 183-day golden rule was not so golden for these taxpayers.
And that's the tax roundup for this month. We hope you have a wonderful Easter. And remember, if you are not already a member of Knowledge Shop, you're missing out on access to work papers, discounted training, free PD, your client newsletters written for you, technical and tax updates, and pretty much everything you need to be in practice. So why not give Julie a call on 1-800-800-232 and you can see it for yourself. See you next month.